And you saw the link about the ETF disclosure?
Yes, yes.
Thank you.
I put that in the description, so all of our viewers who watch, check out the description. I'm even going to put it in the chat at this very moment. And on that note, let me see how we're doing on YouTube, because this is where we're live. We're live on YouTube. And give me 1 second just to confirm that everything is up, running well, and that we've got some viewers. So I'm just going to go over to our content studio here. Okay, things are looking great. So with that being said, ladies and gentlemen, I want to welcome you all to another live show with TradeStation and David Russell. As all of you know by now, David Russell is the man behind the TradeStation account on TradingView. He is the one who's leading this show with his research and analysis, and he is publishing those ideas for everyone, free to the world, essentially, if you end up on the TradeStation page on TradingView. But the important note before we really kick off here and start discussing all markets and the interesting charts that you should pay attention to is that this show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures, and futures options markets. So with that being said, David, great to have you back. I know we have to kick off the show with the disclaimer about ETFs and the returns, so I'm going to hand the mic over to you before we jump right into markets.
Well, thanks, Steph. It's great to be back with everyone. I'm just showing these standardized returns. We will probably discuss or mention a few of these ETFs, so it's just important just to share these with you guys. And Steph has shared the link to a disclosures page on these if you want to check out any of those prospectuses or anything like that. So very good. Well, if you want to, Steph, I wanted to start by taking a look here, not at Tesla, but at the 10-year Treasury, which I have said before is what I believe the most important chart really facing us now. And I think it's interesting to see that, we've had this longer term uptrend in place really since, summer of 22. And we noticed how, essentially we came off that uptrend last summer into the fall. And that's what triggered the downturn in the market last fall. And then basically the market rallied last winter, coming out November, December, as it came down, and now we're kind of right in the middle. Now, if we go to the daily really quickly, we can see, let me just reset this quickly. There was a price gap back here on November 2nd. There was some important data that day, and we've been talking a lot about the importance of that level. And then what happened was we peaked at it in late April, which was a positive sign. And then we came back down to magically hold this same level from June 2008. So it's amazing how the chart can remember these levels from 15 years later. We had talked about this level here as important. It was resistance here. Then it became support when it broke above that in early April. It had the continuation to the upside, came down and tested it. So now we're in an interesting spot where, we have a series of higher lows on the weekly, but we also have the beginning of what could be lower highs. And so I think right now, if we manage to kind of keep a lid on yields here and not have much more upside in yields, that could be really significant to the market overall. And in my view, this is the most important thing right now. This will give us a sense of where interest rates are going to be, expectations for the Fed, and everything else. And, if this really does turn into a triangle, lower highs, that could be something that could represent the fact that this kind of 3-year uptrend that we've really seen since, it's kind of really started here, even in late 2020, right after the election. It was when they had the COVID vaccine and all that stuff. But, right out of late 2020, it's been, consistently higher lows ever since. And now the question is, can we kind of break that? And I think that's what we're going to watch here. And I'll just mention, we have GDP tomorrow, revised GDP. On Friday, we have PCE. But in my view, the thing that we really might be most focused on is going to be June 12th. The morning of June 12th, we get CPI. The afternoon, we get the Fed and dot plot. So that, to me, is kind of the big event that I think we're all kind of, focused on.
So speaking of that June 12th date, do you have an opinion on the current inflation situation? Because I really go back and forth, and I feel like it's so difficult right now to discern. It's kind of been for the 3 years prior, inflation is essentially out of control. And then in the last few months, it's kind of felt like they have it under control. No, they don't. They have it under control. No, they don't. Do you see is there any sort of a symbol that you watch in markets that you're sort of looking for to sort of tell you whether or not inflation's really under control?
Not in the market. When I look at the overall data, I see signs that things are getting better to a certain extent. We've actually seen some real weakness in the housing data. It was very interesting to me to look at the data for April, the existing home sales and new home sales that came out last week. We actually saw inventories are starting to increase. We're starting to get evidence of people cutting prices to move houses. We're starting to see, more supply. We're starting to see the homeowners who are selling starting to capitulate a little and kind of give in and accept lower prices to get deals done. To me, that is what likely is the sign of a market clearing. And so I think we're starting to see some signs of it getting better. The other thing is that energy has really not looked very good recently. If you look at crude oil and look here at the U.S. oil, but basically, we've just had this series of lower highs here. And if you look on the daily here, I mean, there's really not a lot here that is giving me much sense of uptrend. Now, when you look at it, when you look at the data recently, we had this idea that, there was a report recently that Russia is overproducing. There have been multiple reports about weakening demand for energy overall, rising supply. It's a kind of complicated market. There's a lot of things now, especially with the sanctions on Russia, and they have these agreements with countries like India to buy it at discounts. There's a lot of uncertainty to me. I think the market is harder to understand than before. But I think the thing is that historically, when you look at the oil market, it tends to move like in very slow trends. But once we start going back toward production increasing and demand weakening, oil tends to get crushed. And, from my perspective, there are certain things building here that could become positive for the stock market overall. If we do kind of see energy break lower, if energy does really start to, continue to the downside that we've seen since the first part of April, people will be able to not get terribly worried about, even if CPI remains a little bit higher than we expected or core remains a little bit higher than expected, because higher, if energy really does get cheaper, it will drag down inflation overall. So I think that is a positive thing right now. And there seems to be evidence that energy is breaking down. So when I look at energy and I look at the situation in what I said with the housing market, there seem to be signs. And the thing is, how long before that really trickles through? But at the same time, does it really matter? The Fed seems to be wanting to cut rates. And if they see light at the end of the tunnel, there's a good chance that the market is not going to just freak out over one or two high CPI readings. If we're seeing downside in oil and we're seeing a break in the real estate market and we're seeing prices move down in housing, there's going to be a spot there, I think, where the market might be more forgiving. And I think it still creates, some upside risk to stocks where things come in more or less okay and they continue to ease. Last month, I think it was the core CPI was the lowest since sometime in 2021. If you look at things like the Cleveland Fed nowcast, we're looking at a CPI of 0.1%, 0.1% expected for the May reading that we're going to get on June 12th. So right now, I think there's some things where, as much as people might be, anxious about stuff, it does seem like the pieces are starting to come together. There was just more news today. I think it was Walgreens announced more price cuts. Target's been cutting prices. So a lot of these things together, it's a long, slow process. It took a long time for, we saw like the inflation way back appearing in late 2020, and it took 18 months before it really hit CPI. So at the same time, these things are moving the other way. So, well, I think we don't have a lot of clarity on it now. When you look at the way the market is positioned and the amount of cash on the sideline, there's a decent risk that what will happen is that the market will basically buy the rumor, sell the news. And so if people want to wait until inflation really goes down to 2%, we could see, more upside in equities in that time.
Well, David, I have to say, on that note, for the viewers out there, first of all, that's exactly why you tune into this show, because you essentially just synthesized all of the data points, news articles, talking points in that introduction. I thought the comments I just saw that headline about Target, that they're cutting prices. Yeah. And I also just saw the headline that home prices have been dropping in places like Texas and Florida for the first time in quite some time. So super interesting to then also tie that back to oil, which is, the input for so many things, driving cars, airplanes, producing goods. So, wow, it's going to be interesting to watch. I don't have a firm conviction whether or not inflation is under control or not, but this is the first time where I felt like, oh, that's interesting. There's actually a turn potentially occurring, a real turn. So I'll definitely be watching that. And what do you have for us on this chart that you are marking up?
This is the XLE here, and this is the energy stocks. And what's interesting to me is basically, if you look at a retracement here, we tried to hold a 50% retracement, and now it's failing. This is the XLE, which has Exxon and stocks like that in it. And this very often will lead, you'll very often see the producers like gold miners leads gold, XLE leads energy. And it's interesting to see this weakness here in the XLE. Now, what's interesting to me also here is, these series of lower highs, but at one moment, not very long ago, this was the top performing sector on the year. Now it's not. So I think it's interesting to see here that this rally that we had in energy was a temporary thing. And if we're starting to see this failing to hold that 50% retracement, failing to get above its old high from back here 9 years ago or 10 years ago. I can't believe that was 10 years ago. But, I think at this point, we're looking at something that looks pretty range bound here. And, from my perspective, that's kind of what you want to see if you want to see rates come down. So I think, energy right now, I do want to point this out as a reference. I've been just noticing this real weakness here in energy. And we have other stocks. The S&P is, above its high from March. And this thing is basically, breaking back down. I don't know where it is relative to March, but the key thing is that on the short-term basis, the XLE has been breaking lower. So I think that this is when you see energy moving lower and this thing and XLE breaking lower, crude oil breaking lower, that points us in that direction. So this is to me another kind of thing to suggest that, we could be kind of getting closer to the end on this.
Which is a very big deal for essentially 3 years now of trading. We've all been, if you've traded or invested at all in the last 3 years, the inflation narrative has been very important. And this chart now that you have open of the S&P 500, I definitely want to talk about this now in context with everything we've discussed about sort of the headlines that are coming out or data points about inflation. You've got the S&P 500. That's right. Had that nice breakout. Walk us through this too. Is that a moving average you have there with the yellow line?
Yep. It's a 10-day simple moving average. People don't use it a lot, but I find it to be kind of a useful thing for the S&P 500. And I just kind of look at, the direction it's going in. And as long as it tends to kind of keep pointing, I mean, it's a pretty simple indicator. So, I don't want to overplay it, but I think it kind of gives you a pretty good kind of just short-term overall direction. And what's interesting to me is when you see it kind of turn, it does, you can see like a clear downturn there. And then, when it turns, what I like to do is I'm going to add here, and I did a TradingView idea on this. We did one last week. I go to our MA speed, and this is a real simple indicator that shows the rate of change of the moving average. It goes to the 50 by default, so I'll change it to the 10-day, and I like to turn it into a histogram to make it a little bit easier to see. What's interesting to me is that basically I've noticed when you get a thrust, and people look at this in different ways, but it's essentially a price thrust. When you get some kind of clear rip in one direction, you generally don't get a quick drop after that. So if you look back here when we came off those lows, we were jumping up and the 10-day moving average was rising at around, 0.7%. That's the change in the moving average. And when you look at this thrust we had here, it's a similar sort of thing. So from my perspective, if the market is going to drop, we have a certain grace period here before that really happens. So that's one thing I wanted to kind of point out. And that was interesting coming off this bearish outside day, that there was not follow through right away. Why? Because the 10-day moving average was still rising rapidly. And generally, when that's happening, when you have it rising rapidly, it will give you a certain amount of support. And I've just noticed this. It works for the S&P. It doesn't work for all equities, but it usually works for the index, especially if you're in a longer term uptrend. This might give you a false signal if you're ripping off a major oversold low. But the key thing is that in this case, it was, confirmed by the fact that we were hitting a new all-time high. So that was one thing here. But what we have, in my view, is we have the high from March 28th. Now we're trying to turn that, if you look, we're trying to turn that old resistance into new support. So that's one thing. Now you can see how we slammed down and held that on the 23rd, last Thursday, which was a bearish outside day. And then we came down and we're trying to hold it now. So for me, that's an interesting sign. And I basically made a big rectangle to show this entire price range. So, I'm now kind of just watching this. From my perspective, what we could see here is we could see the market behave like it did last April and May. And what it did in that time, if you look back to this period, was it basically moved sideways as we tried to figure out, are they going to raise it? There was serious concern about the debt ceiling and things like that at this moment in time. And we just kind of moved sideways, and then, we kind of continued higher. And I think now we're going to be in a spot where we might move sideways and we figure out, is inflation actually going to come down under control? We have a period of time here where we have about 2 weeks until these big events, and we might simply see this kind of sideways movement. And it could be important to bear in mind the highs and lows of this big outside day and the level from back here in March. So the last thing I'll just say really quickly is, you look at these bearish outside days. This one happened on April 4th, followed by downside. There was another one last summer that it happened on July 27th, followed by downside. So there is some risk here. I think it's important to realize, but at the same time, I think it's important to take a look at the calendar and realize that we have these things coming up. We have the Fed meeting on the 12th that, Powell, they've given a sense that they want to at least not raise rates anymore. But the other thing is that Apple is, in theory, expected to unveil a potential AI smartphone around June 10th. So that is now another catalyst. So I think right now we look out, we can just sit back and twiddle our thumbs to a certain extent, because we have GDP coming tomorrow, but that's data for the period ending at the end of March. Then we have PCE, but that's for April, and we already have CPI and PPI. So that's already rearview mirror. And then we go after that, we have payrolls, and it's like, payrolls are kind of important, but it's not really the big thing that matters. It goes to that week of June 10th through, I think, the 14th with the Apple event, and then CPI and dot plot and Fed and Powell speaking, all those things. So to me, we have that big kind of, linchpin event, that big moment out there in the future. So I think we need to kind of remember that and just kind of see where we are right now and realize that it might be a kind of period of sideways movement as we kind of probe. Do we get followed through to the downside like we had here, which could take another week or two? Or do we hold, and do we just sit and wait and then sneak to new highs like we did right here? And I think that's really the kind of setup that I see before us right now.
So there's so much good stuff to unpack there. The first thing I want to unpack is for the new traders and investors out there. I think on our show, we've got a great routine of giving some really nice educational components to the new traders and investors out there. Your outside days on the chart showing those giant red candles, very interesting at the turning points that those are marking, or in this case, potentially marking, using the sort of historical movements and price action. Maybe you could tell the new traders and investors out there what those outside days are, because surprisingly, a lot of people may not actually know what it is.
Well, outside days are when there's a lower low than the previous candle and a higher high. And very often you get them, especially like these when they're solid. It means the market jumped and then got hammered lower. It opened up at a high and then it got hammered lower throughout the day. They are traditionally considered reversal patterns, and they can be. But they also, in some ways, in my view, are not always that important, because after all, the market jumped to an all-time high. So it was like we made a new high and people were bullish, but it was overbought. If you look, the 10-day moving average can also be useful just as an overbought, oversold indicator. There's another one we've given called distance from MA. And you can just see that when you get really high above, certain moving averages, it can become a relatively effective overbought, oversold indicator. And if you look, we were pretty high above some of these moving averages, like the 10-day moving average on that morning. RSI was jumping up toward overbought, which I'm not going to get into in this, today. But the thing is that we were overbought. So you can say that these candlesticks have a meaning, and there are times when they do. But the other thing to remember is they don't always have a meaning. Look back here on December 6th. We had a bearish outside day. We were near, at that time, what was a 52-week high. And what happened? We sat, we held, and we continued. So I think it's important to realize that candlesticks themselves are nice, but they are one day. And the other thing is that, in my opinion, recently they have not given always clear signals. They'll give a signal that lasts for a day or two, and they just kind of fade away. It's a one-off event that day. I'm pretty sure this was a day after NVIDIA reported strong earnings here, so there was a lot of giddiness, people coming in and just being a little bit complacent, buying the open kind of recklessly. You get that kind of behavior when people are giddy, and it doesn't necessarily mean that suddenly the stock market is entering a significant bear phase. It's just one day.
I'll say, though, on that note, that's why I love candlestick charts, because it can show you all of that information. And those outside day candles that you've highlighted are so interesting, especially when what you just did there by pairing it up with a major news event. NVIDIA is a top 3 market cap company now. It's very important to markets. So it's so interesting to think about this concept that NVIDIA reports earnings, everyone goes crazy. You can see the high there on the candle, and then it just sold off throughout the day. And it does make you think, right? What does that say about markets if the NVIDIA earnings report can't keep the market at those highs? What can? And so that aspect of analyzing candles to that degree is a very interesting study to embark on in markets. And of course, like you said, nothing works 100% of the time, but for research purposes, very, very interesting. Now, in terms of the MA speed indicator, I just want to make sure I have that fully understood. That is coded by TradeStation, and that is essentially telling you to walk us through that one more time of the moving average.
This is basically just a rate of change of the 10-day. In this case, I changed it to 10-day. So basically this here says 0.32. That means that it was rising 0.32% from the previous day. In this case, this is between May 8th and May 9th. So this just says this is how fast it was rising. So the bigger the number, it means that it's rising faster. And then so when things move sideways, not surprisingly, you'll see it flatten out. So what's interesting is you cannot see this really by looking at the 10-day, in my opinion. I mean, I cannot see that difference really, but it makes it so clear down here because it highlights the difference between 0.5 and 0.2. The oscillator allows you to see that. Seeing the actual absolute value is, in my view, it's not that easy to see. So I like it, seeing it as an oscillator. Seth, I wanted to really quickly
Great indicator. I can't wait to try that.
What's interesting, it's really simple. I think the way to view it is the outside day back here on April 4th, when we closed below it on April 12th, that's when we got the follow through to the downside. So I think it's important to realize that a close below one of these lows, like for example, that May 23rd low, or a close, I would say in this case, in many ways, this level here is almost irrelevant. The old high, I would want to put it on the chart, but I think in terms of how the market will react, lows, in my view, sometimes an old high becomes a low. It's nice when it does, but many times it doesn't. It can be much more effective to just look for lows to be lows and highs to be highs. And so this was a low on the 23rd of May. And so now I would say a close under that low on the 23rd of May, which was 52.57 roughly. A close under that could then trigger more selling. And then to view this as a support that could trigger a break to the downside. I think if you look back here, you see the same sort of thing where you can basically see that we held above. And then once we closed under, this was back last summer, July and August. If you look at that level, we closed under it. We went back up and tested it. Look how we went back up to test that level on multiple occasions. right? Right here on August 4th and again on August 10th of 2023. That was the low from July 27th. So we stayed above, then we closed below, then we stayed below, then we followed through to the downside. And even look, in fact, you can even look like this. It remained a level all the way through until basically in September. So the thing is, but the thing that triggered the selling was closing below support. And so I think right now we have a support line that is kind of visible as we jump back to the current time. And I think that that is, something that now we kind of want to keep our eye on this level, this low from May 23rd.
And so interesting how today's price action hit that low and bounced up right there. That catches my attention. And so actually, we could spend so much more time on this chart. And I do want to now talk about something you spoke about with the Apple event coming up. And I'm not sure if you've done any research on Apple or if you're interested in playing. Yeah. This is such an interesting one. And you and I have spoken about this before, in fact, about how Apple is sort of was a little bit behind in the AI race, we could say. Siri doesn't really have any AI capabilities yet. Google's rolling out AI products. OpenAI is rolling out AI products. It just feels like Apple's sort of, hey, they're a little behind here. So knowing that Apple is launching an AI phone is something to definitely look out for. And I can see the headlines already coming through. I think some Bank of America analyst said that they're going to be their biggest, smartphone improvement in quite some time. So, but when you have that chart up, yeah, that looks like a difficult range right now.
It is, but at the same time, it creates the potential for something to happen if it breaks out. And I think there's a few things I think when I talk about the iPhones, I didn't even mention this, but I want to throw it in because there was a thing last week. Microsoft launched AI laptops. Now you have analysts coming out and saying it's going to trigger an upgrade cycle in laptops or in just desktop PCs. Then there's this thing about Apple where now this could trigger the upgrade in iPhones. So you have these pieces of hardware now that are out there. Everyone has an iPhone, everyone has a computer, but most people have old ones. So, the thing is that, this now actually creates a potential for iPhones to be upgraded and PCs to be upgraded. And that in and of itself could be a significant hardware cycle. So I think when we look at Apple overall, the big point is, are they going to mess this up? I mean, that's really the question. Are they going to fail? And I mean, to me, yeah, it's possible they could be another Kodak, but so far that hasn't been their history. So the point is, you're probably too young to even know what Kodak is. However, the point is that, right now, you look at something like Apple, I think you have to realize it's been range bound. It hasn't had the catalyst, but you had an earnings report with this record stock buyback. I think it was 110 billion. It's the biggest buyback ever. And you have basically a range here. And what's very interesting is, and I want to mention this, is technology. The technology sector itself, which includes semiconductors, Microsoft, software. It includes companies that make computers. So it has the chips, the software, and then it has these other companies like Cisco and Apple that make devices. These three parts of technology. Technology, actually, let's look at the XLK, because this is what I want to talk about next. XLK was at one point negative on the year. This is the XLK. At one point, it was actually negative on a year-to-date basis.
Wow, I missed
that,
it by the way.
Flying back, yeah. So what was interesting here was at that moment in time, I think if you look at that time in mid-April, that's actually when the XLE was the leading sector for the year. And now what we've done is we've gone back to technology leading. And I think it's important to realize this because that is the long-term trend. And we had a hiatus here in some ways when NVIDIA and the chips were doing fine, but Apple was not. And we had a period of time there, even when you look at like NVIDIA, they had this big kind of blow off candle that we talked about. And that was basically a 2-month hiatus in tech. And now we're starting to see tech come back as a sector. We're seeing NASDAQ and the overall growth stocks come back. So to me, all these things are coming together and a lot of the move has happened. However, in some ways, Apple is such that's another huge story that it's coming. So I think right now people see that sort of thing coming and it creates a situation where it's hard for people to talk about selling now.
So what you said about Apple, it's almost like their job is to just not screw it up, I think is the perfect way to look at the situation. They have a large cash flow. They have a massive market cap. Like you said, they have the record share buyback. It's like, just don't mess it up. But it is so interesting, though, that for what feels like to me the first time in a while that maybe Apple is sort of in this situation now where there's the opportunity to mess it up. So this release, I'm only realizing now on this live show, needs to be watched very closely by markets, considering as well how much Apple is weighted in various portfolios, ETFs, indexes. And also what I would add to that too is that rotation from energy to tech. I think we spoke about that a month or two ago, but I didn't realize how quickly it shifted. And that's why markets are just fascinating. You take your finger off the pulse for 1 second and the sector dynamics shift almost overnight, because these are large market cap companies. So to see that switch in energy versus tech is just fascinating. And what was the chart that you just had up there for us prior to XLK?
That was NVIDIA, which is obviously outperforming. But what was interesting to me, I wanted to show is the XLK. You basically see starting in mid-February, it basically lagged the market pretty much, and now it's starting to outperform again. So as well, when you look at the NASDAQ, it's also had a period of underperformance, and now it's starting to outperform again. So to me, what's important about the current market is we are seeing going back to where we were in terms of large cap outperformance. And I think when you consider the NVIDIA earnings and the upcoming Apple event, we're in a period here where that old-fashioned kind of market behavior seems to be more of the way things are going. And I think that's to me what I think a big takeaway for the current time is that we're in a spot where there is this short-term trend. There are known catalysts coming up, and that could kind of keep an overall sort of upward trajectory on things, especially when you consider everything we saw about NVIDIA and what it means for the broader space. But then the Microsoft thing, and what that means, that's Qualcomm, that's HP, that's Dell, that's Micron, it's a lot of other companies. So there's a lot of companies now that can participate in this and are participating in it. So I think this is important thing to realize, is that we're simply seeing the market go back to what it was. And I want to now just, there's something that caught my eye earlier that I thought was very interesting. I'm going to show you the XLY. The XLY is consumer discretionaries, and it includes Tesla and Amazon. So I did a thing here when I went to the correlation of this, and the correlation of this to the NASDAQ, which I'm going to add here to the NDX. And what was interesting to me was basically the correlation between the consumer discretionary. Let's get rid of this. Is my relative strength, that you can see how much consumer discretionaries have been lagging all year. And what's interesting here is that this line at the bottom shows that basically consumer discretionaries are not following the NASDAQ at all. Historically, they do. Amazon and Tesla historically. And we're now seeing the consumer discretionary sector completely separate because of the weakness in Tesla. And I mean, there's things about Amazon here where it has been lagging, but it's really interesting to me to see now the consumer discretionary really stumbling. But the two that are really leading now are technology, are coming back just in the last, kind of month, is technology, and then the communications, XLC. So now the XLC, which has Google, it has Meta, it has Netflix. Those are the three big ones, but it also has it has other companies in there like Disney and stuff, but it has those big three kind of growth names. And then you have tech, which is Apple, NVIDIA, Microsoft. So you now have these kind of big Titan stocks. And then the only mega cap, I guess, that you would say is not in those two indexes would be Amazon, which is in the XLY. So you basically have here the big three of communications and the big three of tech are now kind of coming together. And, where NVIDIA goes, it's pulling a lot of other semiconductors. So I think that's kind of what we're seeing now. And the AI thing is essentially, we're in the middle of the trend. I mean, it clearly has run, but then when you consider that we have PCs coming out, we have iPhones coming out, likely. I mean, none of this is official yet, but this is like, a broadly expected sort of situation for Apple. It's not that difficult for you to look out and say, this still potentially has room to move, instead of just thinking that the trend is over. So I think it's important to realize that we're in the midst here of something that there's just reason to see that there's potentially still runway ahead.
That has me thinking. Well, first thing I also want to comment on in terms of the participation that you were mentioning about, which is fascinating about AI, is that the upgrade cycle for some of these companies or the new usage that they'll experience has me thinking that these sectors, the way they are currently constructed or weighted, might not be relevant enough for what's coming or what's actually going to be utilized. And so I was looking at the XLY holdings just a second ago while you were showing that chart, because I was fairly surprised to see that. And it is true, Tesla is definitely getting knocked down, so it's probably taking it down quite a bit. But I see McDonald's, Booking Holdings, Lowe's, TJ Maxx, Nike, Starbucks, and I feel like a lot of those major brands have not had a great year either. So there's really some interesting look at Lowe's in that recent sell-off, which is, by the way, takes us back to the start of our conversation as well, when we were talking about inflation and maybe some sort of signs in the market. And Lowe's strikes me as a company that if it's dropping, and if you're an investor in Lowe's, a trader in Lowe's, its core thing is home building, construction, home improvement. If that's dropping, right, what does that say that the market is predicting into the future? So very, very interesting to pull up those two different ETFs and their holdings. Now you've got ITB up on the screen, U.S. home construction. Walk us through this.
Well, I mean, this is one that we had talked about at various times of seeing, upward direction in it. It's been a long time on this. And, I think right now, if you look at the data in housing, it has not been good. And what's interesting about these home builders is, as it was rallying, these guys were buying down people's mortgages. So what they were doing is they were, paying the points on people's mortgages to move inventory. This is exactly what GM and Ford did like 15 years ago before they went bankrupt. Because what they were doing was they were basically giving you 0% financing, doing whatever they could to move inventory. And then they'd basically give you some rebate and then use that to keep their price high. But then in reality, they were cutting prices and eating margin to move product. And it was a sign of the market being weaker than it looked. They do it to make things look better than they really are. And the home builders were doing this. If you go and you watch interviews with these executives 6 months ago, they were buying down mortgages. Now what do we see? We basically see inventories growing, and we see the last report from these guys was bad. And now we see a lower high. S&P made an all-time high last week. These guys haven't made a new high since the end of March. So I think there's something happening here where we're seeing a lot of evidence. Now, another one to me is BLDR. This stock was an absolute leader in home building. They are Builders First Source. And this earnings report to me was just a total sign of liquidation coming into this space. When I saw this name get liquidated like this, because I was thinking of saying this could be interesting on this pullback or something. I wanted to just watch it, and instead it got just crushed. And so what's interesting is that you'll often find there are stocks that are the leaders in a group or something like that. And this was probably, this stock was one of the most phenomenal uptrends coming out of COVID. I mean, this was an incredible run. I mean, it went from 12 to 200 something. This company is highly leveraged to home building, and they're very, they're interesting how they do their business. But what the key point is this was a leading name that people who wanted exposure to housing were just momentum buying. And then you really see signs of breaking. For me, when this breaks, this actually tells me that the trend we've seen, that maybe, I know, Steph, you're looking for a house, but the trend that we have seen coming out of COVID that has been difficult for so many people, we're finally getting relief now. I think we're getting signs that this impossible housing market is starting to break, because what we're going to start to see is if existing homes come on the market, that will push down the prices. And who's going to pay the price for that? It's going to be the builders, because they've been in a spot when they have an unusually large share of the market, so they can name their price. But the problem is, if existing sales houses start to come online, then people in your position are going to have a lot more options available, and you're going to have a lot of people out there who are going to say, you know what, I have to sell. And when things start selling, then they're going to be like, now I need to move. If they need to move, it means they need to unload their house. So I think that we're seeing this outside of markets per se, or, trading markets, but we're seeing evidence here that this housing market is starting to clear. And we were a spot where the buyers were here and the sellers were here, and that's a frozen market. But they come together, and then you have transactions, you have reality, and it's starting to happen. And I think that the weakness in the home builders should maybe be viewed as good news for everyone else.
So for the viewers out there, especially those who have stuck with this live show, and there are quite a few of you because I get the occasional private message. And, if you go back and watch some of our shows, you'll find that sometimes a reoccurring theme, at least mentioned once, I feel like, every show, if not every other show, is that I am indeed in the housing hunt right now. But it has been a super difficult market. And I started in 2021, so basically at the peak madness. Just nothing really makes sense to me. I go see a house. If the house is on a highway, right, it needs lots of work, and it's selling for close to $1 million. Like really bizarre types of prices. I'm not saying there's anything wrong with houses like that, just that, that's a really expensive home. Now, I must say, spending lots of time on Zillow and Redfin, now going through these charts with you, this is the first time I've seen prices stabilize and the time on market even improve a little. So I can see a house on Zillow and it stays there for a week or 2 weeks or 3 weeks, not just 2-3 days. So this is super interesting. And now you've got Home Depot up, which also seems to be turning quite a bit. And I'm looking at those November lows there and the run it had. So this is some must-watch stuff, not only for traders and investors, but if you're just interested in the economy, or if you're just someone like me and you're in the housing market, there's a lot of science here to pay attention to. Tell us what you're seeing on the Home Depot chart right now.
Well, I mean, to me, this is just kind of confirmation of what you're saying. I mean, the lower high on the weekly versus where it was back in November at the froth. I mean, Home Depot is one of the weaker names, but all these things to me kind of, they give the sense that this was a dysfunctional market. We have to realize the housing market, the way it's behaved the last 3 years is, even after 2008, it wasn't this dysfunctional, because you literally at a spot where the transactions were not happening. And this is what happens when you have a weird disruption and you have people not sure what value should be. So I would just say that we had a freak event because of what happened during COVID. It created a frozen market, and now that is coming back to normalcy. It's just important to realize is that, it's just when transactions are not happening, you don't really have reality. And now we're getting reality, and the reality looks like prices are going to go lower. And as they go lower, we're likely to see that trickle through to the owner's equivalent rent. We're likely to see it trickle through to CPI. And I think that's really the key thing to remember when those things start to happen. And that's why I also was interesting with energy. So,
well, I must say, I await the day we do our live show and I can actually say, I got a home. Yeah, exactly. It'll happen at some point. So now we have Amazon open here, which is one of those charts, which is, I'm so used to Amazon being a perennial leader, a company that is always mentioned with the latest trends, the most important new tools. And this is another company whereby I feel like there's been no comment about AI at all. There's been no product. It's one that I'm watching. Not that I think Amazon's losing its innovation edge. It's still AWS, it's still widely used, it's still a marketplace. But yeah, it doesn't seem to be leading at all. In fact, if anything, it's just dropping through the rankings. I think it's at its lowest market cap ranking in over a year right now. So curious to hear what you're seeing on Amazon.
Well, I think it could be setting up for a breakout. Because now you're looking at a spot where it's just kind of sitting below those old highs from the middle of 2021. And now basically you just have this agonizing. Honestly, as a trader, I just hate things like this. I'm like, you want to buy it and it just bleeds lower. It gives you nothing, but then you're like, wow, it pulled back like 8%. And you feel like it was so agonizing, like trying to get into it. And these can be annoying ones, but this is also a relatively bullish pattern because it really didn't drop very much. And it goes back to hold these kind of levels where it was in the beginning of March. We have this downtrend that there's evidence of it trying to break now. So I think at this point, we had yesterday a false breakdown. Look how it opened at this low, under the low from the previous week, and it came back, fighting back. So from my perspective here, Amazon could be starting. This might be an idea I do in TradingView tomorrow. that we do for TradeStation. But I wanted to point this one up because this is, I think, kind of interesting as well. What happens if Amazon comes off the bench and starts moving again? What does that do to the Qs? What does it do to the overall market? I think that's important to kind of realize is there's things here that can still kind of, come around. And so this is one I'm looking at as kind of interesting. The other thing the thing I would just say is, remember those highs from 2021, you're not going to just necessarily go flying through those. It's going to take some time. You have to pay your dues and kind of, kind of really be sure, things don't just always just go flying through your old highs. It's going to take some time to get through them. But now that we've had this kind of pullback of a few weeks after hitting that high, this could be something where from here, we could actually see a potential acceleration higher. So I think we need to kind of bear this in mind, especially, with the new month starting. This could be one of those names that kind of quietly, moves in a new month. It's had a down month. I don't know if it's been down on the month, but it's been down for about 2 to 3 weeks. The other thing I wanted to just quickly show you, though, was the XLI. And this is important to me because this is, I think, what we're seeing now. You'll notice that, as I said before, the strength is shifting to the NASDAQ, is shifting to tech. The industrials are a very different part of the market. What's interesting here is that now it's range bound. So this also is telling me that we're in a spot here where we could be seeing a shift toward growth. This is not growth. This is a cyclical. This is a value area. And it's interesting to see things like the XLI or the materials XLB just kind of moving sideways. Or in this case, a little bit of a downtrend. You can see it's kind of back to these levels. We had talked at the time about this breakout here, and that was a, that definitely did follow through. But the thing is, now we're at a spot where we're not breaking out. We're hitting that old high. We're potentially entering this sideways shuffle, and I think this is interesting because this also would suggest, in my view, that, the leadership this would be consistent with leadership switching to the NASDAQ. So it's sometimes it's good to look at some of these other things as a kind of confirmation, as you have an investor coming into the market and he's like, I have to put money to work now. I look at the industrials, they look range bound. I look at tech, XLK. Well, you know what? That's actually, hitting new highs. And that is where the leadership and people looking to follow momentum, that is where, right now the charts are kind of suggesting the strength is.
So on that note, I have to say one takeaway for the viewers watching the show, we always like to dive in and remind the new traders and investors out there about market education, is that this is a really nice way to do sector analysis on the chart, which is if you do know the relevant ETFs or symbols that encompass an entire sector, you can breeze through the sectors just like this, or you can ask David questions. He runs the TradeStation account on TradingView. And I do feel like that's a really good tip to point out, because as you're going through these sectors, I'm reminded myself that I need to do more sector analysis like this using the relevant symbols that just embody an entire sector. One more thing about Amazon that is interesting, because I was looking at its market cap after we spoke and you were showcasing this analysis, is that actually Amazon has held up really well. It's just that NVIDIA has just messed up the market cap rankings quite a bit. And for actually now I realize for not announcing any new AI product of any sort, Amazon's actually held up well. Maybe they have something up their sleeve. Maybe they let the Apple event go by, get all the OpenAI stuff out there, let NVIDIA finish its run, and then Amazon might showcase something, because that's actually quite strong considering that there hasn't been any sort of groundbreaking news about Amazon in quite some time. So super interesting there. And your comment about Amazon in the NASDAQ 100 or QQQ, also worth watching for that exact reason. Now, in terms of the builders, I am curious about sort of if you think that the builders, though, I was wondering, can the builders stay strong if the housing market gets weak, or is there sort of a difference between the two? Are they not maybe so connected as I might think? I'm sorry, materials, not the builders.
Materials are all over the map because they have
Gotcha.
chemicals in there. There's a lot of weird stuff in the material space. I would tend to say that what I'm kind of viewing now is when we know the Fed is going to cut, or if we get a real clarity of it, that is when you're going to see the strength shift toward the small caps. It's going to shift toward the cyclical things again. And most of the rallies in industrials and small caps have happened when people thought the Fed was going to cut. And then when people feel they're not going to cut, they stick more at the large caps. So I think we're in a spot right now where if we do get that break in interest rates, it's likely to be after the Fed meeting, or like that July. That's why June 10th to 12th is so important, because you have the CPI in the morning and the Fed after that. So a significant move in interest rates, could very well be after that moment. So it would make sense when you get TNX here. TNX here has these kind of lines, and it could drift between these lines without too much trouble for a few weeks, and then kind of converge into that Fed meeting. I mean, the Fed meeting. One thing that I love about TradingView is you can actually just go and put dates right on the chart. Somewhere you have a signpost. I can't find it right now, but you have a signpost thing that you can go and actually go and so right now, June 12th would be right around here, and you can kind of see where the timing would come together. So I mean, you can see here that there can be a period of chopping easily for a while until that time. So I think right now, we're in a spot where we could see the overall focus being on the growth area, and not a lot with interest rates until that time. Just kind of waiting, for clarity, because at this point, the data, even that's coming out tomorrow and Friday, is relatively old at this time.
So on that note, we are recording this show into the market close. And that's also important, though, because as any true trader or investor or market researcher would want to do, is they want to make sure they are ready for the close. So we have a few minutes here, David, before we head off, and then we'll get to the close. But I want to ask, because we've now gone full circle to this chart of the 10-year Treasury note yield, and I notice you have the June 2008 high showing there. And the reason why I just want to quickly discuss that is that the high right before the crisis? Is that where it goes back to, or is it still sort of okay? So they were starting to cut.
It was the high as the crisis was happening. You kind of had this collapse here, and then this was basically, it was pretty much that summer, and then this was the real crisis right here. This was the real meltdown into 2009.
Gotcha. So very interesting level in that regard. And the other level I'd point out there on this chart that you have, and us being zoomed out now, is I'm actually surprised to know that the TNX never got as high as its pre-financial crisis highs. Yeah, that's interesting. I don't know what it means. I'm just actually surprised to hear it, for as how fast rates have moved. They never actually even got to those pre-financial crisis highs. So with that being said, any final note that we should end on? Maybe, David, you can just remind all of our viewers about the upcoming events that they should mark their calendar on, and then we can get to the market close in the next 5 minutes.
June 10th is the Apple. that's when they're doing the Worldwide Developers Conference. It's widely rumored, or not even rumored, but the analysts are just saying that that's when you're going to get the iPhone AI news. Probably on June 10th. It lasts all week. I don't know. We have the exact agenda yet, but that's June 10th to 14th. Whenever Tim Cook talks, that's when people are going to be focused. So you might want to check the exact details on that. But then June 12th, CPI in the morning, Fed in the afternoon. And then before that, we do have tomorrow we have GDP, and we have PCE on Friday, and we have payrolls on the 7th. So those have some potential, but I do think that middle of June period is the key thing. And the other thing I was mentioning is to remember that kind of low, a close under that low from last Thursday would, from that outside day, would potentially represent something that could be more of a negative. So
with that, ladies and gentlemen, we will wrap up the show. And I'll just say, David, before we head out of here, that conclusion gives us perfect material for the next chat, which is we'll be able to see how how Apple has moved after its AI announcement, and we'll have some Fed data to work with. So we'll head out of here, and we'll make it to the market close. And David, as always, thanks for making it to the show. For all of the viewers, follow the TradeStation account. They are on TradingView posting ideas. David just showed you some of the scripts they've got. That's the place to be. So thanks again, David.